Now today we've seen oil and gold spike while the stock market sold off sharply. We thought we'd bring on an expert to get his point of view and have him make it all make sense. Please welcome to the show, live from the New York Stock Exchange. I think you're our first person. We've probably done 900 shows, David. I don't think we've taken anybody live from the New York Stock Exchange show. There you go. That's fantastic. That's a great shot. Thank you for being on. Thank you for living up to your commitment to be on the show. The week in review. What stands out to you? What should we be looking at? What are your thoughts here?
Well, Scott, we've had a very interesting week. I mean, whether we're talking about disputes between Trump and Elon, whether we're talking about now, the bookend of the week is that there's this new Middle East tension that's rising up, and now we're seeing some new things that are taking place. We've got stablecoin legislation that's been going through, but just as you noted here in your headline, we got some low CPI prints, and so that's obviously wonderful. It was much better than the alternative for sure, and so it seems like Jerome Powell is going to be a little bit late here, and I've obviously been personally critical of some of his actions and saying that it's kind of weird how he was maybe a little bit political there during the election time frame, and then now he's not exactly doing it. But one thing that's important to note is that the consumer right now is not able to buy houses. They're not able to put more on their credit cards today, and so I think at some point we will see slowdowns, and we might see the everything that Jerome Powell's done catch up to us all at once. And so they call that the lag effect. And we haven't really seen it all at once, but maybe that's coming. Not really sure, but these headline numbers are certainly looking good right now, and it seems like we should be preparing.
Yeah, and to your point, I've thought about this too. And I hate to say it, but I agree with you, so we should probably be worried about that. You know what? If he waits too long, he might have to cut sharper and deeper than he'd like to, right? And he doesn't want to have to do that. So the longer he waits, the more he puts himself in maybe a little bit of a difficult position, right?
Absolutely. Yeah. And I'll just tell you, I don't personally think that the Fed has control right now. I mean, if we just look at where inflation is taking place today, it's not in the things that the Fed affects. In fact, the CPI numbers I constantly refer to as the CP lie, because it has nothing to do with anyone's actual expenses. You go to trueflation.com if you want that information. But what we want to understand right now is, hey, what do we need to do with interest rates? They cannot remain this high with this much debt that's coming through. That's why we've got the safety play happening. And to your point earlier, everyone's running to gold. They're running to silver. Silver's had the most incredible last couple of weeks. I think that if people are not paying attention, this thing is heating up right now, and it's about to lap what gold has done in growth here over the last couple of years.
And to your point, I wanted to go back and kind of circle back and highlight this. One of the things that people are getting killed on, especially if you live in Florida and California, is insurance, right? We know that. Yep. But you know what? There's the three insurances we're all still getting killed on. The home insurance that we just talked about with California and Florida, car insurance, and health insurance. The Fed and their interest rate policy isn't going to help any of that, is it?
No, they can't affect any of those things. And so this is the part where there's a little bit of a disconnect. And in fact, there's a disconnect to understand that even if inflation goes high, should we raise rates? Well, that is an idea, but that's not actually a proven theory. And so I think that we should be dropping rates right now. I think that we need to understand that the average American is going to benefit from that. But, who knows? Maybe some of this headwind stuff that's taking place in the Middle East ultimately drives the stock prices a little bit lower. And then when Jerome Powell shows up, he goes, hey, you know what? I'm data driven. This seems like an okay time to drop 25 points. But let's just be honest here. 25 basis points doesn't change much, Scott.
No.
And so we've got a long way to go to get down to a place where the average person is going to be able to afford housing again, going to be able to afford their credit cards again. Corporations are going to be able to afford the debt that they need in order to generate this liquidity in the markets going forward.
And the U.S. and its own debt. You're exactly right. And all you have to do is the Fed's equivalent in Europe is the European Central Bank, the ECB. And David, they've cut rates 8 times in the last 12 months.
Yes, they have. And so no one wants the euro right now. I mean, they are way weaker. In fact, one thing I want people to be thinking about is coming up in this next week is the stablecoin law that's coming out.
Right.
Now, what's interesting is that the stablecoins are actually a way to buy long-term treasuries because they're buying the 10-year. And like USDC, USDT, that's a 10-year. But now what the stablecoin legislation is going to do is going to allow gold and silver to now be a part of a stablecoin. I believe that's a catalyst to see gold and silver launch up to new record highs right now. And so I'm pretty excited about that.
Okay.
But that is an answer that we're going to be seeing coming up here. And so be looking for these pro-tax, pro-consumer policies to help us on the supply side, because that is what we're going to need to continue to move this thing forward.
Awesome stuff. Can't wait to see you again this weekend. Thanks for taking us from the floor of the New York Stock Exchange. David Stryzewski coming to us from New York, New York. All right, let's